Dobar dan. Možemo da krenemo. Pre svega da vam saopštim da je guverner.
First of all, I would like to tell you that the governor was not able to attend due to justified health reasons. So I will make the introductory speech at the today's inflation report conference. The governor was looking forward to presenting a special text box dealing with price movements of cheaper brands. That is a text box covering cheapflation. And she really wanted to present this text box to you. Inflation was always somewhat higher than average, and this phenomenon is known as cheapflation. And we will give you more details about it later on. And now we will start with the formal segment. Ladies and gentlemen, esteemed members of the press, dear colleagues, welcome to the presentation of the February inflation report. Allow me first to briefly summarize the year behind us. So prepare yourselves for a somewhat longer introduction. Just as the previous post-pandemic years, last year was marked by global uncertainty, heightened geopolitical tensions, and rising protectionism worldwide. And yet it was the year in which global inflation, which remains elevated, was reined in. On top of this, inflation was contained without triggering global recession, though growth remains below average in a number of countries, including in the euro area, a region particularly important for us. Even in such highly complex conditions, our country continued to demonstrate a high degree of resilience, and we successfully achieved all our objectives. Most importantly, when it comes to monetary policy, in May 2024, we brought inflation back to the target tolerance band of 3 plus minus 1.5%, consistent with expectations, while ensuring that it stays there in the remainder of the year. This helped us support economic growth more directly by cautious monetary easing, more favorable borrowing conditions, and accelerated lending. A favorable growth outlook for our economy was an important feature of macroeconomic trends in 2024. The growth measured 3.9% and was one of the highest in Europe. As we diversified growth sources and responded to challenges in an adequate and timely manner, GDP exceeded the pre-pandemic level by over 18%. I particularly wish to emphasize the new record-high FDI inflows worth 5.2 billion euros in 2024, as well as record-high government capital expenditure worth around 6 billion euros, which are important pillars of investment financing. Though government capital expenditure was fully executed in accordance with the plan, the fiscal deficit of 2% of GDP was lower than projected, allowing for a further decline in public debt. FX reserves are at a record high, exceeding all adequacy criteria and guaranteeing the sustainability of our external position. An increase in the degree of dinarization of loans and deposits, record-high dinar household savings above 190 billion dinars, and a reduction in the NPL ratio to a new low of 2.5% at end 2024 attest to the preserved and further reinforced financial stability. Owing to all these results, the MBS and the government achieved one of our key strategic objectives. In October 2024, Standard & Poor's awarded us an investment-grade rating. And in late January, Fitch affirmed Serbia's positive outlook, leaving room for an investment-grade rating at the time of its next review. Further on, we shall present current economic trends, our new macroeconomic projections, and monetary policy decisions made in the period since the previous report. As I highlighted at the beginning, after retreating within the target tolerance band in May 2024, year-on-year inflation remained within its bounds, measuring 4.3% in December. That is, it stabilized around that level in the second half of the year. In the course of the last quarter of 2024, the contribution of energy prices increased somewhat, mainly due to the low base for petroleum product prices. The dropout from calculation of electricity price hikes from November 2023 worked in the opposite direction. Food prices, mainly on account of reduced vegetable supply following the summer drought, also provided a stronger impulse than in September, whilst the contribution of services prices declined. Similarly to other countries in the region, including the euro area, core inflation remained above the headline figure due to services prices and measured 5.3% year-on-year in December. We would like to draw your attention to two text boxes in the February inflation report, where we provided a more detailed analysis of prices. In one of the text boxes, we analyzed how the distribution of year-on-year consumer price growth in 2024 changed compared to the previous year. The results of the analysis show that the distribution improved noticeably over the course of the year, with a considerable reduction in the share of products and services within the consumer basket that recorded double-digit year-on-year growth. Additionally, the percentage of products and services that did not experience any price increase in 2024 rose to about 25%, with as many as 100 products and services having lower prices than in the year before. In the second text box, we analyzed a phenomenon that is increasingly being discussed worldwide and has come to be known as cheapflation. Cheapflation occurs when, during inflationary pressures, there is a faster price increase for cheaper brands compared to more expensive brands of the same products. Our analysis confirmed that within the food and beverage category between 2022 and 2024, the cumulative price increase of cheaper brands was 5 percentage points higher compared to more expensive brands. The second characteristic of cheapflation was also confirmed. The largest price difference between cheaper and more expensive brands occurs during the most pronounced inflationary pressures. Several factors could be the cause of this phenomenon. First, the demand elasticity for food is generally low, and it is lowest for the cheapest brands. Additionally, price growth can lead to the substitution of more expensive products with cheaper alternatives of the same item, thereby increasing the demand for the cheapest brands and creating additional price pressures. Furthermore, the imperfect market structure makes it easier for producers and retailers to pass increased costs onto retail prices, often more than fully. This is an issue the National Bank of Serbia has repeatedly warned about, and one to which we have consistently dedicated significant attention, urging retailers to be mindful of the important role they play in the supply chain. Under our new central projection, inflation will continue to move within the target band over the next 2 years. The time horizon of our projection. More specifically, year-on-year inflation should move around the upper bound of the target band in early 2025, though we do not exclude the possibility that in some months it could temporarily overshoot the band by a thin margin. Inflation should slow gradually thereafter, approach the target midpoint late in the year, and stay around this level until the end of the projection horizon. Such inflation movements will be underpinned by the still tight monetary conditions, subdued imported inflation, and the anticipated lower global energy prices, according to relevant international institutions' projections and market futures. If the new agricultural season, which begins in May, is average, fruit and vegetable prices should go down and food production costs should decline. The projected movement of real wages in line with productivity growth should help core inflation slow and approach headline inflation level. I wish to emphasize that by adopting a cautious approach and pursuing a responsible monetary policy, we have ensured inflation's return within the target band while maintaining favorable economic growth prospects. Positive economic dynamics extended into Q4 2024 when, according to the source estimate, GDP rose by 3.3% year-on-year, while in 2024 overall it rose 3.9%, slightly exceeding the November projection. Though the negative effects of the drought on agricultural production were stronger in 2024 than we estimated in November, they were more than offset by better outturns in manufacturing and service sectors. Construction also gave a positive impulse, thanks primarily to the implementation of infrastructure projects planned under the Leap into the Future Serbia Expo 2027 program. According to our estimate, quarterly seasonally adjusted GDP growth was around 1% in Q4 2024, and the carryover effect for this year was roughly the same. Under our new projection, we expect GDP growth to pick up to 4.5% this year and range between 4% and 5% in 2026 and 2027, but probably closer to the upper bound of the range in 2027 due to the hosting of Expo 2027. From the aspect of use, GDP growth will be guided by domestic demand, with private consumption growth propped up by higher disposable income and positive trends in the labor market. Fixed investment growth will be supported by increased corporate profitability in recent years, high foreign direct investment inflows, planned government capital expenditure for projects in transport, energy and utility infrastructure, and improved financing conditions amid the initiated monetary easing and receding global inflationary pressures. Exports are also expected to provide a positive contribution, reflecting the start of serial production in the automobile industry and new capacities in the energy sector, despite the still weak external demand, particularly from the euro area. Imports of goods and services will rise faster than exports in 2025 and 2026. However, as the investment cycle accelerates and private consumption goes up, resulting in a negative contribution of net exports. The contribution of net exports is expected to turn positive in the year of hosting Expo 2027. I would like to draw your attention to a text box in this report where we estimated that Serbia's potential output rate will measure around 4% in the medium term, propped up mainly by fixed investment, which is set to exceed 25% of GDP in the next 2 years. We also expect an increase in the contribution of total factor productivity, driven by the application of new technologies in the production process and by digitalization and continuation of structural reforms, particularly in the energy sector. At the same time, the contribution of labor will remain positive, though lower than in recent years. All this should ensure the continuation of Serbia's convergence towards advanced economies, making its growth sustainable over the long run. The current account deficit measured 6.3% of GDP in 2024, close to the estimated average equilibrium rate, as imports of goods and services rose faster than exports and FDI income payments went up. Within goods exports, despite the still weak external demand and challenges in the European automobile industry, manufacturing exports continued up at a rate of around 3% as a result of past investment. Import growth was guided by the imports of intermediate goods and equipment for capacity modernization and investment cycle purposes, as well as by the imports of consumer goods and tourism services, reflecting higher disposable income of households. Despite its increase, the current account deficit was fully covered by FDI inflows, which measured 5.2 billion euros in 2024. This was the fourth year in a row that appreciation pressures prevailed, and the National Bank of Serbia was the net buyer in the FX market. Specifically, the National Bank of Serbia bought 2.725 million euros net in the FX market in 2024 to prevent excessive strengthening of the dinar. The country's FX reserves therefore climbed to 29.3 billion euros at end 2024, further strengthening the economy's resilience to external risks. We project that the share of the current account deficit in GDP this year and the next will be similar as in 2024, and that it will subside to around 4% in 2027 as service exports go up in the year of hosting Expo 2027 and foreign trade improves. A favorable external position will be maintained by the high FDI inflow, diversified by project and geography, and estimated to be around its last year's record high level. Fiscal trends in 2024 outperformed the expectations. This is primarily indicated by the consolidated fiscal deficit, which measured 2% of GDP instead of 2.7% planned under the supplementary budget. Capital expenditure envisaged under the 2024 supplementary budget, 7.3% of GDP, was fully executed, while outlays for the purchase of goods and services turned out lower than projected. At the same time, higher tax revenue mainly reflected improved collection of excise duties and profit tax. Although the medium-term fiscal framework envisaged a more generous fiscal policy for the purpose of funding investments under the Leap into the Future Serbia Expo 2027 program, we do not expect this to undermine the declining trajectory of the public debt share in GDP, which at end 2024 stood at 47.6%, significantly below the Maastricht criterion of 60%. We have not changed the key policy rate of 5.75% since the last inflation report. In making such decision, we were fully aware that a cautious monetary policy is still warranted despite inflation's movement within the bounds of the target. Caution is primarily mandated by heightened geopolitical tensions and global market fragmentation, coupled with the risk of a further rise in protectionism, which could trigger an increase in the prices of energy, primary agricultural commodities, and other raw materials in production, as well as halts in global supply chains. Skyrocketing prices of some food raw materials, such as cocoa and coffee, in global stock exchanges also cause concerns regarding global food prices, as does the dented supply of agricultural produce in the domestic market due to the summer months' drought. Given that past monetary policy easing has fully passed through to interest rates in money and credit markets, accelerating lending, we deem that a cautious approach is warranted and that the effects of past policy rate cuts on inflation and economic activity in the coming period need to be fully considered. Reflecting a more favorable price of borrowing and credit standards easing, lending to the non-monetary sector sped up year-on-year to 8.2% at year-end, with corporate loans rising by 4.8% and household by 10.2%. In 2024, lending was driven more by dinar loans, pushing dinarization of receivables up to 37.4%. Lending growth, along with a lower amount of non-performing receivables as a result of carefully combined and synchronized monetary and macroprudential policy measures, contributed to bringing the NPL share in total loans down to a new all-time low of 2.5% at end 2024. Let me draw your attention to the decision on temporary interest rate cap we adopted late last year with a view to protecting financial stability and living standards of citizens, primarily housing loan consumers, and making the monetary policy transmission mechanism even more efficient by linking the effective interest rates to the key policy rate for some categories of loans to natural persons. Our future monetary policy decisions will also be made cautiously, on a meeting-to-meeting basis, depending on the pace of inflation's slowdown and its key underlying factors in the domestic and international environment, and taking care of the effects on financial stability and economic growth. Ladies and gentlemen, dear colleagues, the macroeconomic projections we have just presented are based on the assumptions that there will be no major tightening of geopolitical relations in the coming period and that global protectionism will not gain considerable traction. Nevertheless, there is a realistic risk of materialization of such unfavorable scenarios for economic growth globally and by extension for a small and open economy such as Serbia. We believe it is important in such complex circumstances that we should continue to strengthen the domestic fundamentals and our resilience to external risks, that we should keep running a responsible economic policy and preserve stability in every sense. Only in this way will we be able to remain on the path of sustainable growth and development, preserve investment and consumer confidence, and direct our efforts towards further strengthening of productivity and competitiveness of our economy and a rise in the living standards of our citizens. We have come a long way toward a medium-income country and a country deserving of investment-grade rating. This is confirmed by the Fitch report, saying that in the period from 2018 to 2024, our GDP per capita rose by over 80%, as well as by the great demand for Dina government securities at the first auction held this year, after we obtained investment-grade rating. Now that we have the momentum, it is important to maintain it. In the remaining part of the conference, my colleagues from the Economic Research and Statistics Department will present our projections in more detail, after which we remain open for your questions. Sava, the floor is yours.
Now we shall talk about the inflation projection, assumptions, and external conditions. I will start first with external conditions, although it seems that they have been abating, but there are many risks there. First of all, the global economy is recovering at a slow pace, particularly the euro area, which is our most important trading partner. There is a risk there. There are some signs of recovery, but this recovery is still weak. That is, it is going at a slow pace. As for global inflation, last year it was reduced, but there are still inflationary pressures at a global level, and compared to the pre-pandemic periods before the inflationary wave we have seen in the past 2 years, global inflation remains high. The decisions of the leading central banks are still not certain. The ECB is in the process of the easing of its monetary policy, whereas the Fed has halted this process. It has slowed the process of reducing its rates. So here we have some divergent movements when it comes to the most important central banks in the world. The new risks concerning protectionism are there as well, including the measures that may be undertaken across the world. They pose an additional risk for the overall global economy. It is important to highlight that the Serbian economy has faced various challenges in the past years as well, but we have remained stable as confirmed by the rating agencies. In October last year, Standard & Poor's awarded us an investment-grade rating, and Fitch has affirmed a positive outlook, so we can expect further upgrades by Fitch further on. As for the projection, in the past 3 months since the previous inflation report, inflation has moved in line with our expectations. It ended the year at 4.3%, and that is the level at which it flatlined in the second half of last year. Similarly to the previous projection, we expect inflation to slow gradually this year. In Q1 this year, we expect inflation to move at around the upper bound of the target, and as of the second quarter, it will continue to decline until the end of the year, where it will reach around 3.3, and next year it will continue to decline to the midpoint of 3%. It is also important to underline that average inflation is projected at 4% this year, around 3.4% next year. As for 4% for this year, it is somewhat more than we had in November by around 0.3 percentage points, most of which relates to the developments surrounding petroleum products in the domestic market, which are under the impact of global trends, as well the dollar's appreciation against the euro, which impacts the price of imported oil, and these prices were higher. And also we have the contribution of the prices of vegetables, which in the third and fourth quarters of last year were higher because of the drought we had last year. So, taking all this into account, the projection is somewhat higher. That is the main reasons behind it. So the path of inflation is seen in a similar way as in previous projections. As for the assumptions for the projection, as for the primary agricultural commodity prices, the global expectations are such that the prices will be stable. So they will moderately increase in the global market, but when it comes to our agriculture, so at the start of the year, we assume that the season will be average, that is that the average agricultural season will produce the growth of around 8% compared to last year, and this is likely to reflect on inflation this year. As for the global price of oil, similarly to the previous projection, we were guided by the futures prices that follow these oil prices. According to futures, end of year, it is at around $73 per barrel. This is not much below the current level, which is 85, 86. For the next year, futures signal $71 per barrel. And as for imported inflation, just as the ECB, the most important for us is the euro area. It is the most important trading partner for us. We believe that inflation will fall from 2.4% in 2024. and then to 1.9 in 2026. And as for economic growth in the euro area, we expect a slight recovery, but still not so fast, from 0.7 estimated for the euro area in 24. We expect it at 1.1 at 25, at 1.4 in 2026. As for domestic factors, domestic demand was a factor impacting inflation, but now we don't expect any significant inflationary pressures going forward. That is, wages will rise in line with the rise in productivity, so there will be no inflationary pressures on these grounds. As for contributions to inflation in this projection, the largest decrease in contribution is expected from the group, which over the past months has impacted the rise in inflation. These are non-food products and services. Services are an important factor impacting inflation, and we expect that this group will reduce its contribution to inflation from 2.2 percentage points to 1.3 percentage points in the first quarter 2026. So the participation of this group of products is now 2.2 percentage points, so it will go down to 1.3. As for other inflation groups, we expect, that is the groups of products, we expect stable movement. The prices of petroleum products in the previous quarter, they rose somewhat more. So this growth should be mildly negative over the next year. As for food prices, they will contribute 1 percentage point to inflation, fruit and vegetables, in the second half of this year, and in early next year, their contribution will be negative. So a negative contribution to inflation, because we took into account an average agricultural season, and as in the second half of 2024, the prices of vegetables were going up. If we have a good agricultural season, and including the base effect, the prices of vegetables should be lower in the second half of this year, and inflation will decline on these grounds. And we also see a growth in administered prices at around 5%, similarly to the previous projections. To sum up, all this is included in the inflation projection. In the current quarter, we expect it to move at around upper bound. As of the second quarter, it will start declining and move towards at the 3% at the end of this year, and in 2026 it will continue approaching the midpoint of 3%.
I would like to present two text boxes from the February inflation report, which the Vice Governor already mentioned. We analyzed prices where we went down to the level of individual products in the consumer basket. Within the first text box that covers distribution of price growth in 2024 and comparison with 2023, so the key findings of this analysis would be as follows. As you were able to hear, at end 2024, inflation was practically halved compared to the end of 2023, when it stood at 7.6%. This reduction in inflation was driven by all of its components, particularly food and energy prices, which previously generated the strongest inflationary pressures. If we compare the price growth of all products and services in the consumer basket at end 2024 and end 2023, we can conclude that at end 2023, nearly 30% of the products and services from the consumer basket recorded double-digit year-on-year growth rates, over 10%. In 2024, this percentage declined significantly, and around 14% of the consumer basket recorded double-digit year-on-year growth rates. And which products are these that recorded double-digit growth rates? These were travel packages, confectionery products, chocolate, coffee, which was, of course, connected with the rise in global prices of relevant raw materials due to the drought in the countries that produce these products. Then also olive oil, utility services such as water and garbage removal, waste disposal services, but of course, this percentage was much lower than in 2023. Another important thing that we wish to highlight is that in 2024, most of the consumer basket, around 30%, had year-on-year growth rates in the range of -1.5% and 1.5%, while 25% of the consumer basket showed no price increase at all. Out of this, 20% of the consumer basket, or translated into figures, into number of products, around 100 products had lower prices in 2024 than in 2023. And here we can also give several examples. These were certain categories of vegetables, primarily because in the first half of the year their prices were significantly lowered. Then also some categories of meat, eggs, mobile phones, laptops, certain audio devices, firewood, and so on. Why is this important? You asked us quite often during the presentations in 2024 whether we expect a price slowdown, and is it possible that some product prices will decline? But what we have seen is that price growth for some categories of products has not only slowed down, but that they also declined. So their prices were lower than a year ago. Now I would like to move on to the second text box, which deals with cheapflation, and which Vice Governor announced. And cheapflation means that in the cycle of rising inflationary pressures globally, the prices of cheaper brands increase more than the prices of more expensive brands. So this cycle of rising inflationary pressures globally engendered several terms, such as shrinkflation, which is when manufacturers shrink products in size and quantity for the same price. Then there is also greedflation, which is an increase in profit margins. It is used as an excuse to increase prices, retail prices, more than the costs of production. And now we have the phenomenon of cheapflation that is increasingly discussed worldwide. We did this analysis for 58 products within the food and beverage category in Serbia in the period from 2022 to the end of 2024. And we conducted the analysis by tracking online prices of different brands for each individual product, and we constructed consumer price indices consisting only of the cheaper brands, of the most expensive brands. And what this analysis has shown is that the prices of cheaper brands within the food and beverage category increased by a cumulative 40% from 2022 to 2024, and that more than two-thirds of this increase took place in 2022, with the growth rate slowing down in 2023 and 2024. For the more expensive brands, about half of the increase occurred in 2022, and they rose by about 35%. So cheaper brands increased by 5 percentage points more than more expensive brands. And what has also been confirmed when it comes to this phenomenon is that the difference in the dynamics of price growth between cheaper and more expensive brands was largest during the period of the strongest inflationary pressures, which occurred in the second half of 2022 and early 2023. We have shown at this slide what this looks like at the level of individual group products, for dairy products, for meat products, for coffee, non-alcoholic beverages, and confectionery. And what we can conclude when it comes to meat products and dairy products is that most of the growth took place in 2022. And then, as of mid-2023, these prices have stabilized and remained very steady, showing no major volatility since mid-2023. As for meat products, a similar thing happened, and these two groups of products show that cheaper brands rose significantly more than the more expensive ones. A similar thing happened with coffee and non-alcoholic beverage prices, though their growth continued into 2024. And this can be linked to the price increase in the global market for coffee, which reached record levels. The only segment where we had a deviation in the several past months is for confectionery products. It is worth noting that only in the case of chocolate have prices of more expensive brands been rising faster in recent months, while the prices of cheaper brands are even falling. So these would be the findings of our analysis. The Vice Governor already said what are the reasons behind cheapflation. I will only recap those reasons. That is low price elasticity of demand for food, which is lowest for cheaper products. Then the substitution effect, where more expensive products are replaced by cheaper ones in period of high inflationary pressures, leading to higher demand for cheaper brands. And these, as we are talking about staples, about food, one of the factors can also be the imperfect market structures, which allow retail prices to rise even more than production costs, and this is something that the Governor has repeatedly pointed out. Let us conclude. Both analyses have shown that price growth has slowed down in 2024. When it comes to food prices, specifically, they increased in 2024 by 4%, and their year-on-year growth was lower in the course of the year than headline inflation. Of course, there has been a considerable easing of inflationary pressures, and we should see further inflation slow down this year from the upper bound of the target band in the first months of the year. It is expected to slow down and approach the target midpoint by the end of the year.
Good afternoon. One of the text boxes in the present inflation report, as Mr. Jovic mentioned, is the estimate of Serbia's output potential. That is the estimate of Serbia's GDP. In economic literature, there are two main definitions of potential GDP. According to the first one, it is a level of production activity, which, along with the existing factors of production and technology, is the maximum level that the economy can achieve, whereas according to the second definition, it is the level of production activity which is inflationary neutral. It does not produce either inflationary or disinflationary effects in the medium run. The output potential is not a variable that can be achieved by calculating macroeconomic data, and that's why to calculate it we use different econometric methods. In this case, we used the Cobb-Douglas production function, which combines labor, capital, and total factor productivity, which measures the efficiency of factor utilization, and it is calculated in such a way that it represents the growth in production, which cannot be directly attributed to any individual factor, neither to labor or capital. As such, total factor productivity is a measure of the efficiency of the use of technology, and it plays a key role in creating the conditions for long-term sustainable economic growth. And as Mr. Vice Governor mentioned, our estimate of potential output in the medium run for Serbia is around 4%. When it comes to the contribution of individual factors, we used data from the Labour Force Survey for the estimate of labour's contribution and registered employment from the Central Register Mandatory Social Insurance. We also took into account demographic factors. The number of working age population is declining, and this decline will be around 0.8% annually, and we will have an increase in the participation rate by approximately the same amount. Within this active population, we also assumed that in the medium run, the unemployment rate will move towards its long-term equilibrium level, estimated at around 7%, from the current 8.5% in 2024 to 7% in 2027. And as a result, we will have a continued increase in employment, that is the number of persons working, at a slower pace compared to previous years. The sources of this growth in employment should be an increase in new persons and in the labor market and the imported labor force. The contribution of labor to potential GDP in the medium run should certainly remain positive, but this positive contribution will be declining in time from around 1 percentage point in 2024 to around 0.5 percentage points in the current year and beyond. When it comes to the second factor, meaning capital, we estimated its initial level as the average capital to GDP ratio for other countries at a similar level of development as Serbia. And to this initial amount of capital, we added for each year the amount of fixed investment, and we decreased it by the amount of depreciation. We assumed that the rate of the amount of depreciation is around 5%. Taking this into account, our estimate is that capital as a factor of production should still have the largest contribution to the increase in output potential. This contribution is likely to move at around 2 percentage points, and it will have a slight upward trend in the medium run. As already mentioned, the factors that should contribute to this include the dynamics of growth in private investment supported by the achieved profitability, continued FDI inflows, more favorable financing conditions, as well as the planned dynamics of public investment. Finally, the contribution of total factor productivity was estimated to be at around 1.5 percentage points in the medium run, and it will go up from 1 percentage point on average between 2020 and 2024. Its contribution will be rising, and this will be supported by more efficient use of technology in production, the application of new knowledge and technologies, the process of digitization, as well as the implementation of further structural reforms. As such, the upward contribution of the total factor productivity to potential output should also contribute to Serbia's continued convergence to advanced economies, and it will contribute to a gradual shift to a new sustainable economic growth model. Thank you very much. We have finished with this part that we have prepared for you. We are open for all your questions. The floor is yours.
I have a question relating to GDP growth projections. So you project 4.5%. The government projects 4.2%, so you're more optimistic than the government. A result of the quarterly survey of the Munich Institute has been published. Their projection is 3%. So currently you're the most optimistic. What is your optimism based on? I know you have 3 scenarios. Is this the most optimistic scenario or your baseline scenario? What is the projection for your most optimistic scenario, given that the environment is abounding in risks? No, this is the baseline scenario that we have projected, and my colleague will explain what are the assumptions underlying the baseline scenario. Just as you said, in the previous issues of inflation report, our GDP growth projection was in the range of 4 to 5%, with the central value of 4.5%. So our projection has remained unchanged, as in the previous issues of inflation report. So it was slightly higher than the projections of other institutions. Of course, projections do not have to be identical. We have an appropriate structure and assumptions that positive trends in construction and manufacturing will continue. In the sector of services, we expect an additional contribution as in the previous year. So with the recovery of agricultural production, just like I said, when it comes to inflation projection, and this applies also to GDP growth projection, we expect average agricultural season, 8% growth. You're nodding now, but when you develop a projection, you take annual average. So when you develop a projection, you always take into account average agricultural seasons in the last 10 years. So this is statistical data. We have not determined it arbitrarily. So assuming the agricultural season is average, we will reach this GDP outcome. In the February inflation report, you have to take these figures into account. You do not have additional available data. So for the time being, there are no risks that the season will underperform. It is too early to speak about that. I don't know anything about the 3% projection of the Munich Institute, but the IMF also projects 4.2% growth for Serbia this year. All our projections are, they're not identical, but they're close. It is important to note what are the drivers of the growth. The key drivers of growth have not changed significantly. So this is the baseline scenario. Yes, this is the baseline scenario. Mira can tell you more about upside and downside scenarios. So this is the baseline scenario. Maybe we should explain the assumptions underlying the baseline scenario. We took into account that the euro area prospects are somewhat less favorable than before. We assumed that euro area will grow by around 1%. And we also assumed that there will be no further introduction of protectionist measures and tariffs. Of course, there are certain risks arising from this. And we also assumed that there will be no additional tightening of geopolitical tensions. So these are the key assumptions underlying the baseline scenario when it comes to the international environment. So taking all this into account, our projection for this growth for this year is 4.5%. We expect positive effects from the opening of new capacities in the automobile industry, the start of production of electric vehicles, serial production, then also from the production of car tires in Zrenjanin. We expect the start of the B3 block in the Kostolac thermal plant, so we expect a positive contribution contribution from the energy sector and an improvement in the hydro potential. So there are many assumptions that appear realistic now. Of course, there are risks to every projection, including this one. The risks, downside risks to this projection is that global growth could turn out lower and that protectionism will rise further and that new trade barriers will be introduced, which would probably bear down on countries introducing them, but also the countries targeted by those barriers and tariffs, especially if reciprocal measures are taken. The extent to which the euro area is affected by these measures will affect Serbia too, but this effect appears to be limited. We projected but also we projected an upside and downside scenarios in case global growth is lower than in the baseline, 3.3%, if geopolitical tensions tighten further, and if additional tariffs are introduced by 10 percentage points. This would mean lower economic growth in Serbia by 0.3 and 0.4 percentage points. This year. Of course, we have a scenario. Of course, we have an upside scenario because there are indications even now that geopolitical tensions will ease, and in that case, economic growth could surprise us on the upside, and then our economic growth would consequently be higher by 2.2 percentage points too.
A question for Mr. Jovic. The Minister of Finance and the President of the government have said that the student protests are affecting economic growth and that this may slow growth. So my question is, how is that possible? We haven't heard this risk here. Is such a projection possible? In all projections that we have produced, talking about inflation and GDP, our baseline scenario does not assume any factor, the impact of a factor of such type. The factors of such type can have a potential to have an impact in the short run, but the time period is too small, so at the level of aggregate quantities, we cannot judge whether such impact exists. The data on such parameters cannot be viewed in such a short period of time. So this is in the domain of politics and not in the domain of the economy. You don't have the parameters confirming what the Minister of Finance is saying. I can't tell you that. I'm just talking to you as someone who is viewing the economic parameters that we are examining here. We need to observe them in a longer period. The most relevant period of observing these aggregates is 1 quarter. So in some cases, it can be done at a monthly level, but this takes time so that we can view the effects. So we always like statistically, we need to conclude the data and see whether there are any effects. Whether there are any data, I'm not negating whether they exist. Perhaps somebody does have such data. Somebody may have a better insight into that. That may be possible, but we cannot see that in our data. We cannot confirm it in our data right now. Also, a question for Mr. Jovic or Jakovljevic. In your projection, we haven't heard about a scenario concerning Nice. So what will happen? Do you have a scenario A, A scenario B, C? How will that impact inflation? I will answer, and then my colleague will join me. So what we can say from the very first moment, when OPEC introduced measures against Nice, we have been talking intensively to Nice. We also had a meeting with Nice and banks. The National Bank of Serbia expects, so what was expressed at the meeting when it comes to payment operations, cash operations and so on. So this will be done smoothly, so there will be no no changes until the status of the company is resolved. As a financial institution, we don't have any right to undertake measures that are more than that. So first, the status should be resolved. With the expiry of this deadline or with the extension of this deadline, perhaps the status may be resolved. We have intensive communication with banks, insurance companies, all financial institutions under our remit. We do not expect changes here, but inside the House, in case of adverse scenarios, yes, we are working on it, but we want to look forward to a positive outcome because this company has a significant share in our financial sector. Banks are largely exposed, as well as insurance companies. There is also a great share in the energy sector, so we believe that the solution will be favorable, but we do have our internal calculations in case of potential scenarios. With the expiry or the extension of deadline, we hope the status will be resolved. We hope NIS will continue to operate. So this is our expectation. Now I would like Nikola to add a few words. Thank you. As for the meeting held between the NBS, NIS and banks, as Mr. Jovic emphasized, we required that all activities of banks towards NIS be continued in a smooth way. And as Željko said, until the resolution of the status, these activities will go on smoothly. From the aspect of activities or the share of NIS as a company in the FX market, we can see that these activities are functioning completely normally by purchasing foreign currency and sufficient quantities of oil. They have ensured the sufficient quantities for the supply of oil of citizens and the economy, and they're also processing this oil into petroleum products. So we have seen no slowdown in activity when it comes to NIS, because we can look at the time series and compare it with the same period of the last year. And as Mr. Jovic emphasized, we do hope for the best solution, because there are two working bodies that are working on resolving the status of NIS from the aspect of the ownership structure and from the aspect of the continuation of operations, and the fact that on the 10th of January NIS was put on the OFAC list of sanctions. So perhaps some licenses could be issued individually or aggregately, we will see. So one more question. Perhaps I haven't heard well. It was not about FDIs. FDI inflows and outflows. I would like you to comment on FDIs and how do the FDIs impact inflation. So we mentioned the figure for the last year. So we saw a record high level of 5.2 billion euros last year. As for the start of this year, we don't have official data. We have preliminary data, and we can see a slowdown in January. But it is still, compared to January last year, we do have a smaller inflow. But we also have the remainder of the year to compensate for this. As for other movements, these are preliminary data, they're not final. So once we have final data, we will present them to the public. So we have a preliminary data, as I said. It is, the inflow is smaller compared to January last year. Once we obtain official data, as so far we will share them with you. There are no reasons not to share these data. We cannot guess at the figure. When it comes to FDIs, we need to monitor a few things. It is the trend that we have had over the past 10 years. FDIs are more than sufficient to cover the current account deficit. And for this reason, in the past 7 to 8 years, along with the rise in exports and the inflow of FX on these grounds, we have had appreciation pressures, an increase in the supply of FX, and a rise in FX reserves. Also, when it comes to FDIs, we have to take into account their structure, the diversification of FDIs in terms of products that they're channeled to, that is the branches they're channeled to, and the sources, that is the countries they come from. And that's what we have been talking about at all previous presentations. When it comes to FDIs, you cannot look only at 1 month of a single year. We have only January now. They have seasonal movements as well. We need to have several months in order to have comparable data, so as to compare these figures with previous years.
You talked about interest rates, and you said that your monetary policy stance remains cautious because the ECB and the Fed are pursuing divergent monetary policies. When will interest rates be in such a corridor so that you can loosen up your monetary grip and ease interest rates? As you could hear in the previous part of the conference, since last year, since May, we have seen inflation's return within the target band. It has moved around 4.3% in December 2024. So we're within the target band, but of course we continue to take further activities towards ensuring inflation's convergence to the target midpoint in the projection horizon. Based on current data and based on all the risks, we decided to remain cautious in our monetary policy decision-making, taking into account all the factors from the domestic and international environment. Each month at executive board meetings, we consider these developments and we decide on the level of the interest rate. We see a general decline in inflation, and we see a kind of tendency towards a gradual but cautious decline in interest rates. This is what I can tell you based on everything. If Mira wants, she can add something. Perhaps I would like to add 2 things that we should take into account, and that is that the European Central Bank is in a different cycle now. Namely, it has to support euro area growth, which is still anemic. And on the other hand, we do not have this problem. In all quarters of the previous year, we recorded positive quarterly growth rates. So we cannot talk simply about copying someone else's monetary policy, because in addition to general conditions, we have to consider some other factors too. Some are specific to individual economies, and what we have at this point is exceptionally high uncertainty in the international uncertainty, and that is why the Fed expects an additional increase in tariffs, then whether the fiscal policy will be more accommodative. That is why we are more cautious in relaxing monetary policy stance. So we do not look up to any central bank. We have our own monetary policy stance. We take into account all factors, and as Vice Governor Jovic said, we want to see inflation closer to the target midpoint. Another important element is the fact that monetary policy easing by the European Central Bank in part spills over to our market through lower interest rates on euro-indexed loans. So a part of increased expansiveness of the European Central Bank spills over onto our market and onto our lower interest rates.
Anna Ristović, Bloomberg. I would like to ask a question about trading chains. How do you assess the effects of the boycott of the retail chains? And the second question concerns the procedure initiated by the Commission for the Protection of Competition. Did the Commission issue any report? Colleague Sava will tell you a few more details. But first, I would like to add a few words. You had the chance to see several times that the National Bank of Serbia back in 2023, that is the NBS governor, pointed out the way of the formation of prices and the problem of spreads in retail chains. Over a long period, we have had working meetings with the management and competent people in the retail chains. We've been dealing with this topic for a long time, and as the second step, we have seen this step of the Commission for the Protection of Competition, and we have an open procedure of supervision as well as for the possibilities to view the effects of the boycott and the movements in the field of trade spreads and the chain of the price formation. I would like my colleagues in charge of statistics to comment on this. The effect of the boycott of retail chains is hard to estimate when it is a boycott over 1 day or 5 days, and it happened relatively recently. And for macroeconomic data, we need to view data for an entire quarter and to see whether there is a decline in turnover. As for short-term events and effects, they may have a signaling role rather than an impact on economic movements. So just 1 or 5 days in an entire year, they cannot change anything, actually. So this is a signaling effect in terms of whether retail chains, in terms of the manner of formation of prices by retail chains. And as the Vice Governor said, the Governor Tabaković was highlighting so many times the prices, what should be pointed out, and what lies within the competence of the National Bank. We have meetings with retail chains. As for the Commission itself, we cannot communicate their findings. They need to express these findings in public first.
Yesterday, several central banks sent a joint letter to the European Commission asking for a certain loosening of regulatory rules which were introduced during the coronavirus pandemic. They said that these rules slow down competitiveness and economic growth. Are there similar initiatives here in Serbia? Are there regulatory rules that affect competitiveness here in Serbia? We have a very open relations with the corporate sector, and if there were any problems in the prior period, it was sufficient to contact us, and we would be able to arrange a meeting and to resolve any issues. For instance, now when NIS approached us, then at a while ago, Mercator approached us, and we were open every time. I do not know currently of any outstanding issues that it would require any resolution formal resolution. Do we have strict standards when it comes to account opening for legal entities or natural persons, observing the AML regulations? Yes, we do have strict regulations, and it may seem to people that it is too strict, but through efficient procedure and efficient conduct of bank employees, this can be resolved quickly. It only requires a certain degree of cooperation. I'm trying to recall any issues, but I cannot. Maybe there were some complaints regarding AML regulations, but no, there can be no shortcuts here. You have to present all detailed documentation about the beneficial owner of the company, who stands behind the company. So the procedures are often lengthy, but any company that has some issues can approach us. There were never any systemic issues that required joint and collective action by the companies.
Is there sufficient money if the sale of NIS is offered? Do we have sufficient reserves for a larger transaction? For the time being, there is information that the Russians are not really willing to sell it, but if necessary, do we have enough money for that? We can only answer from the aspect of the sufficiency of FX reserves. As Vice Governor said, FX reserves at the end of last year reached a record high level of 29.3 billion euros, up by 4 billion euros. Since 2018, they've been going up each year by over 19 billion euros. And this is just the sufficient chance. So for any need of the government, we do have sufficient FX reserves, which according to all the parameters and criteria for the measuring of the adequacy, they are more than sufficient. When we talk about one of the parameters, that is the coverage of average imports, the minimum required is 3 months. We have over 7 months of coverage by our FX reserves. When it comes to the coverage of short-term debt, thereby 5 times higher than the minimum. We have just sufficient FX reserves for any type of FX obligations of the government going forward. We need to say that the stock in dinar and FX accounts of the government, so FX accounts are part of the FX reserves, so these amounts are more than sufficient to cover any FX obligations. These are internal buffers, internal reserves, which have been accumulated over the past years in order to settle any potential obligation. Thank you, Nikola.
Dodat će Nikola za odbranu kursa, ali samo čisto da skrenem s Nikola napomenuo, znači
So it is about the sufficiency of the reserves. They're at 29.3 billion. They're absolutely sufficient. We need to say we cannot use the entire amount of reserves for payments of NIS or any other thing. FX reserves are independent. We can use only that part of the FX reserves, which equals the balances in the government accounts. But this is also sufficient. Although the value of NIS is large, we do have sufficient reserves from that part, which can be used from the government part. So this amount is sufficient to execute the transaction in question. So now regarding the interventions, when it comes to the interventions, that is the potential for any defense of the exchange rate and depreciation pressures. In the past 7 years, we have had constant appreciation pressures, and for this reason we've been buying foreign currency and boosting FX reserves. Since 2017, the National Bank of Serbia has net bought 11.4 billion euros, and this is just sufficient potential for meeting any elevated demand for foreign currency while keeping maintaining the relative stability of the exchange rate in the coming period, and according to the projections, FDIs should continue to cover the current account deficit this year and beyond, and consistent with this, FX reserves could go up and not be used for any abatement of depreciation pressures.